The Bank of England base rate is falling, but inflation is on the rise. So, which savings accounts are managing to offer the best rates? Welcome to Which Money. Hello, I'm Lucia Ariano, and joining us this week we have Matthew Jenkin from Which Money. Hello, Matthew.
Hi there.
And another familiar voice from NerdWallet, their lead writer, Amy Knight. Hi, Amy.
Hi, lovely to be back.
It's so good to have you back. Well, shall we start then by setting the scene? Matthew, do you want to just remind us what the base rate is, how it's set, and what happened with the latest decision?
You'll hear a lot about the base rate on the news and might be wondering what it is. Well, to sort of in a nutshell and why it matters to savers, the Bank of England sets the base rate every few months. Their latest, the last time they met and made a decision was on the 8th of May, and they decided to cut it from 4.5% to 4.25%. And then you might be wondering, well, why does that matter to savers? Well, it matters because providers often they'll respond to any sort of movements in the base rate, and when it drops, it usually results in the interest paid on savings accounts dropping with it. And so the accounts that are affected the most are usually instant access accounts. They're usually the first casualties of any sort of base rate drop. And that's mainly because their rates are variable, and providers can tweak them whenever they want.
We've had 4 consecutive cuts since August last year. Amy, do you want to take this one? Have banks been anticipating the latest cut and already bringing their savings rates down?
A lot of them have been, yes. People use this expression baked in to talk about inflation being baked into the economy, but also things like mortgage rates and savings rates. Some of the forecasts about what the Bank of England are going to do in the months to come are baked into the rates that are on offer currently. So yes, the latest rate cut in May was widely anticipated, and a lot of providers will have already priced that in. However, we think that there could be more rates to come, rate cuts to come. So if you're currently sitting there smugly thinking, oh, well, nothing's happened to my savings rate, don't count your chickens.
Shall we talk about the savings rates then? Matthew, I know you've been doing some analysis on this. So where should we start? What can you tell us?
Yeah, so as Amy mentioned, and you mentioned yourself, this is the fourth time since last summer that the base rate has dropped. Before that, it was going up and up, like 14 times it was increased by the Bank of England. And as a result of that, savings rates were booming. They kept going up and up. They reached like a peak of 6.2% in back in October 2023. So that was brilliant news for savers. But since then, they've been sort of coming down, and every time the Bank of England has cut their rate, banks have responded in turn. So I took a look at rates on all instant access accounts, which, as I said, are usually the first casualties. And I looked at those just over a week before the latest base rate cut and 5 days after. And interestingly, they didn't drop. They weren't dropping as fast as previously. When I've done analysis back in November, we saw it was a 19% of accounts of those instant access accounts cutting rates. This time, I found just 7% had dropped their rates within that sort of time period. It's not a huge proportion, but most of the cuts actually came from smaller banks and building societies that had market leading rates. In some cases, the reductions were significant. Interest rates on account by Chip, who have been the market leaders, fell by more than 1 percentage point. So they sort of tumbled down the rates table. Of course, things might change, and they may have changed since. More banks might have responded. I did this analysis a couple of weeks back. So the main message here is that, as Amy said, if you haven't already switched to a deal with a higher rate, now's a really good time to start looking at your options and move.
And with only 7% cutting so far from your analysis, do you expect that other banks will soon follow?
Yeah, absolutely. I mean, I think there's, as I said, there's a lot else going on in the market apart from the base rate. So it could be for various reasons why they've decided not to respond as quickly as before. But I think it's unlikely that rates are going to go up. They're more likely to, they might stay steady for a while and then start to come down. I mean, when I've looked at I can't remember the figure just off the top of my head, but I was looking at the average rates from comparing April to May, they were dropping. So it's not, there might be a few ups and downs, but I think the general direction is down, unfortunately.
And speaking about these other things that might be affecting savings rates, shall we bring back inflation into the equation? Amy, shall we just start by, talking about why this is important for savers?
Yeah, I think maybe the first thing is just to explain what the relationship is between money that you deposit in a bank and money that's then lent out by that bank to somebody else, because this is where interest rates on borrowing and interest rates on savings are really tied together. So it is the same money. When you put savings into a bank, the bank is able to use that money that you've entrusted them with to lend somebody else, whether that's a loan or a mortgage. So when the base rate comes down and they can't charge as much interest to the borrower, that means they can't pay as much interest to the saver. Now, what's happening with inflation? We've obviously been grumbling about the cost of living for years now, but essentially money that you keep as cash, so if it's not earning any interest at all, inflation is nibbling away at the value of that money. So as the price of stuff that you want to buy goes up, if your money's not growing at the same rate, your spending power is going down, and the things that you want and need are going to get less affordable. So just to put that into actual monetary terms, if you had £1,000, the amount of stuff that would buy today, inflation, the latest ONS figures came out on the 21st of May, and we hit 3.5% inflation. So that means in a year's time, the same stuff is going to cost £1,035. So that just highlights how inflation is sapping away at your spending power, and that's why it's really important to beat inflation. I remember when I was young, my dad would always go on about, oh, are you beating inflation? Have you got your savings somewhere that's beating inflation? I couldn't really get my head around what he meant, and I wasn't really engaged in it at that time. And now I'm obsessed. Literally, I'm looking at all my different savings pots, making sure that any money that I'm not going to need instant access to is at least getting more than that 3.5%, so that it's growing and it's just staying ahead of CPI.
And can we bring in then the base rate and how that's linked to inflation?
So the base rate is what the Bank of England use to try and balance the growth of the economy. That's a good thing. GDP going up is a good thing. It's not been doing very well recently. And inflation. Now, we tend to talk about inflation purely in negative terms. Actually, you don't want it to go to zero. That's why the Bank of England has this 2% target. 2% CPI, that's consumer price inflation. You say that the economy is ticking along nicely. And it's when the inflation rate gets a lot higher than that, so currently we're edging dangerously in the direction of 4%, that's when it feels really uncomfortable, because households and individuals struggle then to keep up with the rate that those prices are rising. So the Bank of England uses the base rate as a tool. It says, okay, if we put interest rates up higher, that's going to cool down demand. People will stop spending as much, and that will bring inflation down a bit. And then they can do the opposite. If they really want to get economic growth going, they can bring interest rates down, and hopefully that makes us feel like we've got a bit more money in our pockets. We go out and spend it, and that helps boost the economy.
So in today's case then, the base rate has gone down, but inflation has gone up. Is that a surprise?
The fact that the inflation rate went up more than expected was a surprise. I don't think anybody thought that inflation was going to go down because we had an absolute whopper of an April in terms of loads of high household bills going up all at the same time. So I probably don't need to give you the whole list, but some of the big ones were energy bills, water bills, council tax, and then lots of smaller ones as well, like broadband and mobile phone bills. At the same time, we had national living wage and minimum wage going up, and the national insurance contributions for employers also went up in April. So it was an unusually high month, and that's why I think the Bank of England still felt able to cut. They knew there was going to be a bit of an April spike, but it's not like inflation is expected to do that every month for the rest of this year.
So hopefully some good news at least. So before we dive into the depths of different types of savings accounts and which one is right for you, shall we just cover in a nutshell, Matthew, can you actually beat inflation with some of the accounts on the market right now?
Yeah, it's a good question. The good news is that yes, the majority of savings accounts on the market do offer rates higher than 3.5%. But because of that spike that we saw in April, there are less savings accounts that can beat it. So the number of savings accounts that can beat inflation has dropped. It was more than 80% back in the previous month, and now that's dropped down to 70% of all products. And that includes instant access, variable rate deals, fixed rate bonds, and ISAs. So yeah, there are less. But again, as Amy said, we're not expecting inflation necessarily to stay at that figure. It could drop next month. Awful April, as they dubbed it, had a major sort of hand to play in that.
Well, after a quick break, we'll be back to dive into some of those types of accounts and help you decide which is right for you. Welcome back. Now, before the break, Matthew was telling us about the best rates right now. But often with so little difference between instant access and longer term rates, how can our listeners decide how long they should lock up their cash for?
So if you're thinking about, if you're sort of sitting on the fence thinking, oh, shall I, instant access rates, they tend to be a bit higher compared to 1 year fix or longer, then you've got to bear in mind that when you fix, you're locking into a rate that's going to stay the same for the period of your of the account. So if it's 1 year, it's going to stay at that rate. It's not going to change, unlike an instant access account, which, as we've mentioned, is variable and can go up or down. And at the moment, it looks like the direction is obviously down. So you might be opening an account with a slightly lower rate. However, it's going to stay the same, and by the time you get to next year, that instant access rate that you had your savings in could be a lot lower. So in the long run, your returns are likely to be much bigger with a fixed account.
And what about some of the other kind of nitty gritty details that we might have to consider? Stuff that would be in the terms and conditions, things like deposits or, monthly minimum deposits.
Sure. I mean, with a fixed account, though, you've only got like usually a 2-week window from opening in order to sort of fund that account. So you've got to be sure that once that money is locked away, that you're not going to need it in an emergency. So you might want to have a proportion, an emergency savings fund with an instant access account, and then put a big lump sum in a fixed. Uh, you know, and then you've got to think about how long you want to fix it for. How long are you prepared to lock that money away? If you put it in an account lasting 2 to 5 years, you could actually be better off. Because then fixing for 12 months, because after your 12-month account has matured, or the term has ended, you might think, well, I'm going to fix for another year, but by that point, you might be settling for a much lower rate when it's time to reinvest that money. So it's all going to depend on your circumstances.
And are there any regular savings accounts that are attached to current accounts that you would like to shout out? Are any of those, offering these top percentages?
Yeah, I think the important thing to know is that regular savers they do function in a different way to an instant access. Um, some, as you mentioned, do require a current account with the same provider, and unlike fixed bonds or instant access accounts, which allow you to deposit a lump sum, you're going to be much more restricted on the amount you can pay into a regular saver. Typically between 250 and 500 pounds. So there are people who maybe they're suitable for people who don't necessarily have a massive amount of money that they want to invest. They're just starting out saving, and you just want to sort of drip feed that account. Sometimes they also only apply the rate that you get also only applies for a limited time, often about 12 months. And you don't take that headline rate at face value. I'm going to tell you some of the headline rates, and you might think, wow, that's really impressive, but you might actually find you might be disappointed to find your actual returns are much lower, and that's because of the way regular savers work in practice. They place a limit on how much because they place a limit on how much you pay in each month. You'll only earn interest on relatively small sums of money for most of the year. But if we want to look at some of the top rates, for example, at the moment, Principality Building Society has a 6-month regular saver, and that's offering a rate of 7.5%. First Direct also has a top rate of 7%, and so does the Cooperative Bank. So they're pretty impressive. But as I say, the way that these accounts work in practice means you're not going to get quite as much as if you were putting your money into an instant access or a fixed account paying the same rate.
And 7%, I mean, that sounds quite attractive to me. So in my instance, then, I feel like many of our listeners could be in this position. You don't already bank with one of those banks. You don't have a current account with one of those. So could it be worth switching your current account or opening a current account with one of those just to get the regular saver?
Potentially, it could be. If you've been a little bit disappointed with your bank anyway, perhaps you're not finding the mobile banking experience as good as you were hoping. Maybe your bank is one of the ones that's suffered an outage in recent months that caused you a lot of inconvenience. So you're already thinking of leaving them. Well, this could be the thing that sort of tips you over the edge if you get this amazing 7% savings rate at the same time, then yeah, why not? And switching using the current account switching service should take roughly a week, and it's actually quite painless.
Something we've talked about quite a lot with all of the switching bonuses that we've seen over the years. And we haven't talked about ISAs too much just yet. So let's bring them in now. Matthew, are they worth considering too, given, of course, the tax-free allowance?
Yeah, I mean, that's the main draw to an ISA. You can save up to £20,000 a year tax-free, and very often the rates are equally attractive. You've got a range of options. You've got instant access, and you also have fixed term accounts. So quite similar sort of options. And again, the main attraction is being able to save £20,000 without paying a penny to the tax man. So if you have a large sum of money, they're definitely an attractive option, and you could have a cash ISA where you can save up to 20 grand, and then mix and match, have another fixed term account or an instant access. So there's no reason why you can't do that. And one of the dangers at the moment with higher rates, especially if you're opening a fixed term account paying an attractive rate or an instant access savings account, is the fact that you could end up being liable for a tax bill at the end of the tax year. So you've got to tread carefully.
I'm a really big fan of the mix and match option. I think everybody needs a little bit of money that they can access instantly. The example I like to give is, if wherever it is you've got to drive to later today or tomorrow, you hit a pothole, all of a sudden you've got to replace a tyre. If you've not got any spare money, if your budget is so tight that your outgoings are, carefully calculated to make it to the end of the month, that's where your emergency fund is really going to come in handy. Then you've got your easy access stuff where perhaps you don't need the money instantly, but you're not prepared to take any risks with it, so you don't want to put it in the stock market, for example. Then it's somewhere, and that's where you might keep your sort of 3 to 6 months worth of, if I lost my job, how do I cover my bills pot of money. And then you've got your longer term savings goals, and that's where something like a fixed term account or an ISA that might be invested in stocks and shares works really nicely.
I like that mix and match idea a lot. And there has been a lot of talk about whether or not the Chancellor will drastically cut this tax allowance for ISAs that we've been talking about. Amy, has there been any updates there?
No major updates. There were lots of rumours circling about the cash ISA being axed in the spring statement, and nothing came of it. So for now, the conversation's sort of bubbling away still under the surface. The idea behind it is really that if we limit the amount that people can save into cash ISA, then if they still want to take advantage of the tax-free allowance, the stocks and shares option means that they've got to put their money into businesses. And if the government was to set something up where that money went to support British businesses, that could be a huge win for the economy. So there's logic behind it. Unfortunately, not every saver is comfortable with stocks and shares, particularly having just seen what's happened with the Trump administration and certain policies that really sent the markets doolally. People want the option, they want the choice to be able to put their money into cash savings because they know that it's not at risk. So there's some mixed feelings about whether putting a limit on cash ISA savings is fair, reasonable, and if the government does decide to do that, there's going to need to be lots of clear communication, reassurance for people about how it's going to make them better off, not just make the government better off.
And speaking about, the different types of savings goals you might have, the longer term goals, shall we bring in savings platforms quickly, Matthew? I know it's something you've been looking into. Are they something that's worth considering?
Yeah, definitely. So you've got platforms such as Raisin, Hargreaves Lansdown, and the idea behind them is that they help you source market-leading savings accounts. They do some of the shopping around for you. All you have to do is register, and once you've done that, you'll only have one set of login information to remember. Most platforms will contact you when any bonds that you've taken out for a fixed term bonds are set to mature, and that'll reduce your risk of your savings languishing in a low paying account. If you're like me, you've completely forgotten about where you put your money, and 1 year comes around, it's like, oh my goodness, yeah, it's coming, and then you just completely forget
downside.
to do anything. Yeah,
it's the downside to the mix and match, I suppose. You have to actually keep on top of things.
That's it. I've set up a little folder in my inbox. When there was a flurry of sort of great rates, and I tried to move my money around, and then suddenly it was like, oh my goodness, where did I put it? Fortunately, most providers will, they will email you and give you a heads up. But yeah, savings platforms are one way to sort of take the stress out of that, and to jog your memory a little bit. And it also means you're not going to miss out on a top rate offered by a provider the platform doesn't include. However, it's still worth shopping around, and not just looking at the rates rates quoted on the savings platform, as sometimes they don't always have the best rates. So you've got to do a little bit of your own homework too.
And finally, then, to go back to a point we were talking about earlier on in the show, we're in this kind of unusual position with the base rate falling and inflation rising. And, also, we have just hit awful April. So what do we expect to come?
I mean, I don't think we're not going to see rates rocket up. I think they could bump along for a while. And again, it's going to depend on, the base rate, how inflation's doing, and, the market in general. I think the general direction is going to be down. I can't see us hitting those, big, like 6% interest rates on savings anytime again soon. But I mean, it's worth adding that, uh, if you do look at sort of the general direction and the trajectory, it's not as severe as some might have expected. So it's not it is sort of coasting along, and rates are still very attractive. So it's not all doom and gloom, but I don't think we're going to be seeing another savings boom like we did in the last few years.
And Amy, is there anything that you'd add to that?
Just that I feel very sorry for the 9 people who are part of the Monetary Policy Committee, because what an awful decision they have got to make on the 19th of June. They're in a really difficult situation. They got a lot of unknown quantities floating around, not just domestically with our inflation, our services inflation. That's predominantly industries that employ a lot of people, so retail, hospitality, those types of companies where they need lots of staff and therefore wages are a huge cost burden for them. So they've been hit with minimum wage increases, they've been hit with higher national insurance contributions, and that's why the services part of the inflation figure is one of the things that just won't come down. At the same time, we've got the stuff that's going on with President Trump, negotiations with China, our own negotiations with the EU. We've got political negotiations happening between Russia and Ukraine. Will they, won't they strike a peace deal, and how might that affect the energy markets? So all of this stuff is floating around. Ultimately, the aim of the game is still the same. So the Bank of England does want to bring the interest rate down because it wants people to feel they've got more money to spend. And when I say people, I mean you and me, but also businesses who could invest, and that would help to drive economic growth.
Well, thank you both for joining us today. It's been great to have you on the show.
Thank you.
Thanks very much.